If the dollar in your pocket quietly buys less every single year, how would you protect the work you already did to earn it? Most Americans focus on earning more income, building businesses, and investing in markets they hear about every day. Very few pause to ask a deeper question. What happens when one single asset class dominates their entire financial life? In the first 30 seconds of this conversation, understand one thing clearly. Diversification inside metals is a strategy of balance, structure, and control. Gold, silver, and industrial metals each move for different reasons inside the American economy. When you understand those reasons, you gain clarity instead of confusion. In the United States, gold has historically acted as a store of value during periods of currency pressure and economic stress. Central banks hold it. Institutional funds allocate to it. American investors purchase physical bullion, exchange-traded products backed by metal, and shares of mining companies. The reason is simple. Gold tends to react when confidence in currency weakens or when geopolitical tension rises. Its movement is tied to perception of stability. That characteristic gives it a specific role inside a portfolio. Silver operates differently. It carries monetary history like gold, yet it also has industrial demand. In America, silver is used in electronics, solar panels, medical equipment, and precision instruments. This dual identity causes silver to respond to both economic growth and investor sentiment. When manufacturing expands, demand can increase. When fear enters markets, investor buying can increase. That combination creates wider price swings than gold. Wider movement means greater potential fluctuation, which requires position sizing discipline. Industrial metals such as copper, nickel, aluminum, and lithium function as economic activity indicators. Copper wiring is present in construction and infrastructure. Aluminum supports transportation and packaging. Nickel and lithium are deeply connected to battery production and advanced manufacturing. In the United States, federal infrastructure spending, technology expansion, and domestic manufacturing initiatives directly influence demand for these materials. When factories expand production, industrial metal demand often rises. When production slows, demand softens. These metals reflect economic momentum more than monetary perception. Now consider a common American investor scenario. Many portfolios are concentrated in equities tied to corporate earnings. When growth slows, stock valuations can compress. Metals introduce exposure to physical assets with supply constraints and global demand cycles. The goal is structural balance. Gold may respond during currency stress. Silver may respond during industrial expansion combined with investor demand. Industrial metals may respond to construction growth and manufacturing output. Holding each in measured proportions spreads exposure across different economic drivers. Allocation requires intention. Professional asset managers in the United States typically treat metals as a percentage allocation rather than a full strategy. The size depends on risk tolerance, liquidity needs, and time horizon. A disciplined approach often keeps metals within a defined range of total portfolio value. Rebalancing annually or semi-annually can maintain structure. When one metal rises sharply, trimming excess and redistributing to underweighted areas restores alignment. This mechanical discipline prevents emotional overexposure. Storage decisions matter. Physical bullion requires secure vaulting. Some Americans use insured depositories. Others prefer allocated storage services. Exchange-traded funds backed by physical metal offer liquidity through brokerage accounts. Mining equities introduce operational risk, management risk, and cost exposure. Each vehicle carries different characteristics. Simplicity supports clarity. Investors who prioritize stability often lean toward physically backed instruments over operational businesses. Supply dynamics add another layer. Gold supply grows slowly due to mining constraints. Silver production depends partly on base metal mining since much silver is a byproduct. Copper production is capital-intensive and tied to global mining projects that require years of development. These supply characteristics influence price cycles. Limited short-term expansion can amplify price movements during demand spikes. Understanding production timelines helps investors avoid reacting emotionally to short-term volatility. American tax treatment also shapes decisions. Physical precious metals held for over a year may be taxed under collectible capital gains rules, which differ from standard long-term capital gains rates. Exchange-traded structures may vary depending on legal classification. Awareness of after-tax impact protects net performance. Consultation with a qualified tax professional ensures compliance without speculation. Liquidity planning remains essential. Metals can fluctuate significantly. Investors should avoid allocating funds needed for near-term expenses. Stability improves when metals represent strategic reserves rather than emergency funds. Structured diversification means metals complement broader asset categories instead of replacing them. Consider infrastructure expansion across the United States. Large-scale energy projects, electric vehicle manufacturing growth, semiconductor fabrication plants, and grid modernization efforts increase industrial metal demand. Copper wiring, lithium batteries, and nickel alloys become critical inputs. Silver demand from solar manufacturing can expand with renewable energy deployment. These structural shifts support long-term industrial consumption trends. However, volatility exists. Commodity markets respond quickly to global events, currency shifts, and production disruptions. Professional discipline involves predefined allocation limits, periodic review, and avoidance of concentrated exposure driven by headlines. Metals perform roles. They do not carry entire financial plans. The deeper lesson is strategic layering. Gold offers monetary resilience characteristics. Silver offers blended monetary and industrial exposure. Industrial metals provide economic growth sensitivity. Combined thoughtfully, they reduce reliance on a single economic outcome. Diversification inside metals mirrors diversification across asset classes. As you reflect on your current allocation, ask yourself a simple question. If one economic scenario unfolds, does your portfolio depend entirely on it? Structured metal diversification introduces multiple demand drivers under one strategic umbrella. It requires research, patience, and discipline. It rewards clarity over excitement. We began with a question about protecting the work you already did to earn your money. The answer is not complexity. The answer is structure. Gold, silver, and industrial metals each hold defined roles within the American economic system. When you assign them roles inside your portfolio with measured discipline, you build balance grounded in tangible demand realities. Real diversification begins with understanding what each asset actually does. When professionals construct diversified metal exposure in the United States, they begin with economic mapping. They identify which forces influence each metal, and then align allocation with those forces. This method transforms metals from emotional purchases into structured components of a disciplined financial architecture. Start with gold. Gold pricing often reacts to currency strength, real yield expectations, and global uncertainty. When inflation pressure rises in the United States, investors sometimes seek assets perceived as stores of value. When geopolitical events elevate uncertainty, capital can flow into gold-backed instruments. Gold does not generate cash flow. Its value rests in scarcity, durability, and broad recognition. That recognition matters. Gold trades globally with deep liquidity. Central banks hold it as reserves. Institutional funds allocate small percentages as stabilizing elements. Its historical resilience across economic cycles supports its position as a strategic anchor within metal diversification. Silver introduces complexity. Its industrial consumption accounts for a substantial portion of global demand. American solar manufacturing expansion directly affects silver use in photovoltaic cells. Electronics manufacturing and medical applications add consistent demand layers. Investment demand can accelerate price movement during periods of heightened market attention. Silver AES price volatility historically exceeds gold AES due to its smaller market size and blended demand base. This volatility requires thoughtful position sizing. Overexposure can amplify portfolio swings. Balanced allocation integrates silver for growth sensitivity while respecting its movement range. Industrial metals require deeper economic analysis. Copper serves as a prime example. Construction of residential housing, commercial buildings, power grids, and data centers drives copper usage. Federal infrastructure initiatives in the United States, including bridge repair, broadband expansion, and clean energy upgrades, increase demand projections. Copper mining capacity, however, cannot expand instantly. New mines require environmental review, capital commitment, and multi-year development. This delay between demand signals and supply response can produce cyclical price surges. Nickel and lithium connect strongly to battery technology. Electric vehicle production facilities expanding across the United States depend on these materials. Domestic battery manufacturing plants increase localized demand. Supply chains remain global, exposing pricing to international production shifts. Aluminum supports aerospace, automotive, and packaging industries. When manufacturing output rises, aluminum consumption follows. Each industrial metal carries its own demand cycle linked to specific economic sectors. Professional diversification inside metals, therefore, rests on proportional exposure. One approach used by experienced portfolio builders involves core and satellite structuring. Gold may represent the core allocation due to its monetary characteristics and liquidity. Silver and selected industrial metals function as satellites tied to growth sectors. The ratio between core and satellites reflects investor objectives. A stability-oriented investor may weight gold more heavily. A growth-oriented investor may modestly increase industrial exposure while maintaining discipline. Vehicle selection influences risk profile. Physical bullion ownership eliminates counterparty risk when stored in allocated form. It introduces storage logistics and liquidity planning. Exchange-traded funds backed by physical metal offer convenience and daily trading access. Futures contracts provide leverage and short-term positioning tools, typically used by advanced participants due to margin exposure. Mining company shares introduce operational variables including production costs, management efficiency, and geopolitical risk in mining regions. Each instrument modifies exposure characteristics. Risk management requires scenario awareness. Consider a slowdown in manufacturing output. Industrial metals could soften due to reduced factory demand. Gold may respond differently if currency uncertainty rises simultaneously. Balanced exposure across monetary and industrial metals spreads reaction patterns. This internal diversification smooths performance across varying economic conditions. Rebalancing remains critical. Suppose silver rallies sharply due to strong solar demand and investor momentum. Its portfolio weight may expand beyond target levels. Selling a portion and reallocating to underweighted metals restores proportional balance. This disciplined trimming converts volatility into structural advantage. Without rebalancing, concentrated exposure can develop unintentionally. Cost awareness also matters. Expense ratios of exchange-traded products reduce net returns over time. Storage fees for physical bullion accumulate annually. Trading spreads affect entry and exit efficiency. Transparent evaluation of total holding cost supports informed allocation decisions. Tax structure in the United States influences net outcome. Physical precious metals categorized as collectibles may incur different long-term capital gains treatment compared to standard securities. Some exchange-traded structures pass through collectible treatment depending on legal design. Mining equities follow corporate stock tax rules. Accurate understanding of classification prevents unexpected after-tax impact. Macroeconomic monitoring enhances strategic timing without encouraging speculation. Indicators such as manufacturing purchasing manager indexes, infrastructure spending announcements, energy transition investments, and currency trends offer context. Context informs allocation adjustments within predefined ranges. Discipline avoids reactionary trading driven by headlines alone. Liquidity planning integrates metals within broader financial architecture. Metals should align with long-term allocation rather than short-term expense coverage. Emergency funds typically remain in highly liquid cash equivalents. Metals operate as structural diversifiers rather than transactional tools. Supply chain resilience represents an emerging theme in the United States. Efforts to strengthen domestic manufacturing and reduce reliance on foreign supply influence industrial metal demand projections. Semiconductor fabrication facilities require copper-intensive electrical systems. Renewable energy projects increase silver and aluminum usage. Electric grid upgrades expand copper consumption. These structural shifts shape long-term demand outlooks. Environmental regulations influence mining output. Stricter permitting standards can delay new production, affecting supply expansion timelines. Recycling efforts contribute secondary supply, especially in aluminum and copper markets. Monitoring regulatory trends provides insight into production constraints. Historical performance analysis supports measured expectations. Gold has experienced multi-year cycles of appreciation followed by consolidation. Silver has demonstrated amplified cycles. Industrial metals track global growth patterns closely. Past performance does not guarantee future outcomes, yet historical volatility ranges inform realistic risk assessment. Portfolio integration extends beyond metals. Equities, real estate, and fixed income instruments each respond differently to economic conditions. Metals represent one layer within a comprehensive allocation plan. Overconcentration in any single asset category reduces diversification effectiveness. Education strengthens conviction. Understanding why each metal moves builds resilience during price fluctuations. Investors who purchase without comprehension often react emotionally during volatility. Structured knowledge reduces impulse decisions. Consider a hypothetical American investor with a diversified equity portfolio exposed heavily to technology companies. Adding industrial metals aligned with domestic manufacturing growth can broaden exposure beyond software revenues into physical infrastructure expansion. Adding gold introduces monetary resilience characteristics. Adding measured silver exposure integrates renewable energy demand participation. Each addition serves a defined role. Transparency and documentation support discipline. Recording target allocation percentages, rebalancing thresholds, and holding rationale establishes accountability. Periodic review ensures alignment with evolving financial goals. Diversification inside metals requires patience. Commodity cycles can extend for years. Short-term fluctuations do not define long-term structural trends. Professional investors maintain allocation within predefined ranges rather than attempting precise market timing. Security considerations remain practical. Physical metal holders should verify vault auditing standards and ownership documentation. Exchange-traded product investors should examine custody structure and redemption mechanisms. Mining equity investors should review balance sheets and production reports. Due diligence transforms exposure from speculation into structured investment. The psychological dimension deserves attention. Tangible assets often provide emotional reassurance during uncertainty. That reassurance can support disciplined behavior across broader portfolios. Emotional stability strengthens long-term consistency. Ultimately, diversification with gold, silver, and industrial metals revolves around role clarity. Gold anchors monetary perception sensitivity. Silver bridges industrial growth and investor demand. Industrial metals connect directly to manufacturing expansion and infrastructure development. Allocated proportionally, monitored regularly, and rebalanced methodically, these metals contribute structural depth to American portfolios. Financial architecture built on understanding withstands turbulence more effectively than portfolios built on trends. The purpose of metal diversification lies in balancing economic drivers within a single strategic framework. When allocation decisions reflect research, cost awareness, tax understanding, and disciplined rebalancing, metals become components of a resilient design rather than isolated bets. As you evaluate your financial structure today, examine whether your assets depend on a single economic storyline. Diversified metal exposure introduces multiple demand engines under one disciplined plan. Clarity creates confidence. Structure builds stability. In the end, strength in finance grows from intentional balance grounded in real economic function.